Hey there, this is Michael with Buffalo Finances, and I get questions all the time about what do I do when I sell my house? Am I going to pay a lot of taxes? What do I do with the money from the proceeds? Should I pay down my mortgage? Things like that. And so if you're selling your personal residence, that's different than selling a vacation property, which is different than selling a business property, one that's an income property. So if I'm selling my personal residence, let's just say I've been in there for more than 2 years, just to use an example, then I'm going to get an exclusion on the gain of the sale of the property. So let's say that I bought the property for $200,000 and then I sell it for $300,000, just as an example. And that $100,000 gain between the purchase price and the sale price, that is going to fall under an exclusion. So if I'm single, then the exclusion is $250,000. If I'm married, it's $500,000. So that means that if I get a gain that's less than the exclusion that applies to me, I don't owe any tax on the sale of my personal residence if I've been there for more than 2 years. Now, if there are some nuances to that. If you've only been in the house for a short amount of time, we'll have to check the details on that. But if you've been in the house for more than 2 years, then it lived in for more than 2 years, the last 2 years, then you will qualify for an exclusion amount. So if you sell it for more than a gain of $500,000 and I'm married, then I'm going to pay tax on that difference. So let's say I sell my house for $1 million because I got an awesome house and I had bought it for 400 grand. That would be a $600,000 gain. I'm going to get taxed on the part that it's not excluded. So $600,000 gain minus $500,000 exclusion. If I'm married, that's a $100,000 gain, and that'll be taxed at a capital gains rate, which is lower than ordinary income. And you could be anywhere from 0 to 20%, let's say 23% tax rate for federal. So that's how you evaluate tax gains. And if in order to prove that, the best thing to do is get the closing statement for when I sell it and the closing statement for when I bought it. And if you don't have those, you can go to the records online. There's a lot of records nowadays, unless you bought it from pre-1980s, then it's gonna be hard to get those records. But you can go online and get those if you don't have them. You could just go to your county's real estate assessment data. They document when title changes and the purchase price. But you'll need your purchase price and your closing price when you sell it. And you'll also want your closing costs, because that's gonna affect if you gained money or not, all right? So you need your closing statements, and these are just some generics. If you have this situation going on, I recommend tax planning, which will really help dial in how much money you actually made on the property for tax purposes and how much you're gonna have to save for taxes. If you do owe taxes on the sale of your property, then the government wants that money in the same quarter that you made the gain. So I've had it before where clients sell a property in January, and then they don't tell us about it until we do their taxes a full year into the future. And the government wanted the taxes related to that sale in the first quarter of that year. So for 9 months, the IRS assessed interest and penalties for underpayment. And I don't want that for anybody. One other thing to remember is that if you pay your mortgage down, that does not affect the purchase price or the cost of your property. So if you try to pay your mortgage down faster, that's good for you financially to reduce interest, but it doesn't help you with taxes. It doesn't have a tax effect. So hopefully that's been helpful. This is Michael with Buffalo Finances. To learn more about tax planning, email us cpa@buffalofinances.com. Have a wonderful day.